Welcome to The Deep Dive, your go-to source for cutting through the noise of earnings calls and getting right to the core insights.
Glad to be here.
Today, we're unpacking a fascinating paradox from Check Point Software's latest quarter, which was reported pre-market on July 30th.
Yeah, quite the situation.
On paper, their numbers looked solid beats on revenue and EPS, yet the market, well, it slammed the stock, sending it down significantly.
It did?
So why the disconnect? It seems like a classic battle playing out in the cybersecurity sector right now. Check Point's formidable financial fortress versus investors' insatiable demand for rapid growth.
That's exactly right. It's a clear case where fundamental strength met a very specific market anxiety.
Okay.
We're going to dive into exactly what happened in those numbers, what management emphasized during their call, and what investors are truly scrutinizing in this evolving cybersecurity landscape. It's not just about the numbers themselves.
It's the story behind them.
Precisely. It's about the narrative.
Okay, let's unpack this financial mystery then. To start, maybe let's look at the headline figures.
Good place to start.
Check Point reported non-GAAP EPS, which is their adjusted earnings per share, at $2.37.
Right.
That was just ahead of the $2.36 consensus, a healthy 9% year-over-year increase.
Following increase.
Their GAAP EPS, the standard accounting measure, also climbed 6% to $1.84. Revenue came in at $665 million, slightly beating the $662 million consensus. That's a 6% increase year over year. So far, on the surface, those are all beats, which usually spells good news.
On the surface, absolutely. Top and bottom line beats are typically met with applause, but here's where the plot thickens.
Okay.
The figure that really captured investor attention and where the immediate concern arose was calculated billings.
The billings.
Think of billings as, future revenue, what customers are committing to spend down the line. It's often seen as a key indicator of growth momentum and pipeline health.
Makes sense.
This came in at $642 million, growing 4%, but notably missing consensus expectations by about $7 million.
Ouch. Okay, so even with strong cash flow.
Exactly. Even with robust cash flow, their operating cash flow was $262 million, up 31% year over year, representing an impressive 129% of GAAP net income. That billings figure was the red flag for the market. It basically overrode everything else.
So the billings miss, that's the crucial point then. Management had a very specific explanation for it, didn't they?
They did.
It wasn't about a lack of demand, but more about timing. Is that right?
Precisely. Management attributed the miss to a heavily back-end loaded quarter.
Meaning?
Meaning a bunch of deals, specifically several seven-figure deals, simply slipped from the very last days of the quarter into the first 2 weeks of July.
Okay, so just barely missed the cutoff.
Exactly. And here's the kicker. They stress that these deals have already closed.
Oh, interesting.
They believe this will directly benefit the third quarter. It truly does sound like a timing issue more than a fundamental demand problem, which is an important distinction.
But it clearly spooked the market anyway.
It clearly did, yes.
That makes sense. So despite that short-term hiccup, what else was driving their revenue growth? Anything specific?
Well, what's fascinating here is the continued strong demand for their new Quantum Force appliances and product refreshes.
Okay.
That's what powered their 6% revenue growth overall. Quantum Force appliances, in particular, posted double-digit growth.
Double-digit, wow.
Yeah, driven by customers upgrading your systems and the increasing demand for advanced AI-powered inspection capabilities. This shows a healthy underlying demand for their core security offerings,
Right. And I think I read that a larger portion of these deals were bundled, like including the product and ongoing subscriptions and support, often at higher discount levels.
You did.
That sounds like a bit of a trade-off. It led to a slight slowdown in subscription revenues and even a decline in support revenues for the quarter. How does management view that? Is that a concern?
You've hit on a critical strategic point. While there was a short-term deceleration in some revenue lines, management views these bundle deals as a long-term positive.
Okay, how so?
They argue it strengthens customer relationships and significantly expands their install base for future upsell opportunities.
The long game.
Exactly. It's a strategic choice, sacrificing a little bit of immediate revenue recognition for deeper customer stickiness and, a wider foundation for growth down the line.
A long-term play, then. Makes sense. Now, while those deals bring long-term stickiness, let's talk profitability. Their non-GAAP operating margin remained robust at 41%. That's pretty strong.
Very strong.
But even a fortress like Check Point isn't immune to external forces like currency fluctuations, the strength of the U.S. dollar, apparently.
Exactly. Even with those strong margins, they're seeing the impact of currency fluctuations, specifically the weakening U.S. dollar against the Israeli shekel.
Yeah.
This is expected to be maybe a 0.5 to 1 point headwind to operating margins in the second half of 2025.
That's not insignificant.
No, it could potentially increase operating expenses by $50–60 million in 2026 if current exchange rates persist. It's a significant external factor, largely out of their control, that will definitely bear watching.
Absolutely. Beyond the operational financials, Check Point continues its share buyback program,
Always a good sign.
repurchasing 1.5 million shares at an average price of $220 this quarter. That's a classic signal of confidence in their own valuation, right?
Definitely suggests they think the stock is undervalued.
Yeah.
They also completed the Veriti acquisition back in June for about $90 million in cash.
Very right. That deepens their threat exposure management capabilities.
Correct. And strategically, their CEO, Nadav Zafrir, articulated 4 guiding principles for the future.
Okay, what are the...
Securing the connectivity fabric, a prevention-first ethos, an open platform philosophy, and an AI-first security approach.
AI first. Interesting.
And he specifically highlighted strong growth in email security, SADAN's that's Secure Access Service Edge.
The cloud security platform for remote workforces, essentially.
Exactly.
Yeah.
And ERM, or enterprise risk management portfolios. All of those, he said, reflect their prevention-first strategy.
This brings us to a crucial part of their strategic direction, then. Check Point is clearly accelerating investment in SaaS,
They really are.
opening a new R&D center in India and doubling their SaaS R&D team. That sounds pretty aggressive.
It is. And this aggressive move has already led to recognition in the 2025 Gartner Magic Quadrant for SaaS and as a leader in the Forester wave for zero trust platforms.
Zero trust, never trust, always verify. That's key these days.
Absolutely. They're also expanding their MSP, or managed service provider, offerings and pay-as-you-go options for their workspace platform, just pushing for broader customer access and more flexible consumption models.
Which is essential for modern businesses.
Totally.
And on that open platform philosophy you mentioned, management discussed this quite a bit, didn't they? Especially with all the competitor acquisitions happening.
They did. They believe an open approach offers CSOs, that's Chief Information Security Officers, crucial flexibility.
Avoiding vendor lock-in.
Exactly, helping them avoid vendor lock-in. And it also provides, they argue, greater security resilience by integrating with other best-of-breed solutions. This directly contrasts with an all-in-one monolithic approach that some competitors are pursuing.
It's a philosophical divergence then,
It
right?
absolutely is. And their investment in AI is foundational to this whole strategy.
Yes, the AI first principle.
They're not just talking about AI, they're embedding AI engines directly into their products for unified management and, to simplify customer operations.
So it's not just a bolt-on feature.
No, definitely not. It's seen as a pivotal, industry-wide shift that will enable security solutions to make real-time decisions and automate threat responses in what's become an incredibly fast-paced threat landscape.
Okay. So after all these strategic moves and financial nuances, what does this all mean for their outlook? What did they guide for next quarter?
For the third quarter of 2025, Check Point is guiding revenue between $657 million and $687 million,
Okay.
with non-GAAP EPS between $2.40 and $2.50.
And the full year, did they adjust that given the billings miss?
Crucially, no. They reaffirmed their full year 2025 guidance. They're still projecting revenue between $2.66 billion and $2.76 billion, and EPS between $9.60 and $10.20.
Interesting.
Management even expressed positivity about finishing at the higher end of that range, citing strong indicators and, of course, those deals that closed in July.
So they sound confident despite the market reaction. What about growth acceleration? Did they talk about when that might pick up?
They did. Regarding growth acceleration, management acknowledged it's not an overnight shift. It's more of a journey.
Right.
They're focusing on improving their go-to-market strategy, making those hefty investments in AI we talked about, and fostering a culture of execution and urgency.
Okay.
And while appliance refreshes and that bundling strategy might temper subscription revenue initially.
Because of the discounts.
Exactly. Their new high-growth product lines like Email, SANS, and AirM, which are exploding at over 40% year over year, are expected to accelerate subscription growth in the coming quarters.
40% growth is huge.
It is. It's also worth noting they confirmed that recent geopolitical events, specifically the Israel war, did not have a direct impact on their operations or that deal slippage.
Good to know. They chalk that up to their global presence and business continuity plans.
That's what they said. Robust programs in place.
Okay. Now, this raises a crucial question that gets to the heart of our deep dive. What's the bigger picture here for investors?
Right.
The immediate market reaction, with the stock falling nearly 14.5%, clearly indicates investors were fixated on that soft billings figure.
Absolutely fixated.
It completely overrode the beats on the top and bottom lines and even management's reaffirmed guidance. It's pretty stark.
This points directly to that margin fortress versus growth angst narrative playing out in real time.
Explain that a bit more.
Well, Check Point consistently delivers strong gross margins, typically above 85%, and impressive free cash flow conversion that 129% of GAAP net income truly validates its capital-light model. It's a profit machine.
Okay, the fortress.
Exactly. However, the market, especially after a competitor's massive acquisition in the sector just that morning.
Palo Alto buying CyberArk for $25 billion.
Right. That news likely made the market prioritize top-line acceleration and platform consolidation over pure profitability, at least for now.
And the pre-call sentiment was already a bit shaky, wasn't it, because of that deal?
It was. That Palo Alto news definitely stirred consolidation fears across the cybersecurity sector, amplifying investor scrutiny on Check Point's growth metrics.
I heard buy-side desks called the billings miss a yellow flag on pipeline velocity.
That was the chatter, despite management stressing a solid pipeline and talking about growth reacceleration in the second half.
So a disconnect between management commentary and market perception. What about sell-side analysts? Were they aligned?
Not really. Sell-side analysts showed a real divergence. Some cut price targets because of the slower billings.
Focusing on the growth angst.
Right. While others maintained positive ratings, citing Check Point's consistent gross margin resilience.
Focusing on the margin fortress.
Precisely. And Check Point itself is positioning its Infinity architecture as a single vendor SaaS, counter to the full stack pushes from competitors, believing their hybrid architecture offers better user experience and cost control. It's really a battle of philosophies playing out.
So credibility now really hinges on management translating that Veriti acquisition roadmap and their expanded direct sales efforts into actual tangible billings traction by Q4, doesn't it?
That seems to be the key. They need to show, not just tell.
What are some key upcoming catalysts for listeners to watch for then? Things that could shift this narrative?
There are a few major ones coming up. First, the Q3 results on October 30th. That'll be the first quarter, with a full contribution from Veriti.
Okay, important data point.
Then there's an Infinity Next Gen launch event planned for early October. Also, potentially large federal zero trust contract awards slated for November.
Government contracts.
And longer term, macro tailwinds from the 2026 EU NIS-2 compliance spending requirements kicking in.
Lots to watch.
Definitely. The narrative arc for Check Point is clearly shifting from its historic defense-first focus towards an AI-orchestrated, cloud-delivered platform strategy. If management can hit its mid-single-digit revenue growth target while preserving those 40% plus operating margins,
then investors might re-rate the stock.
Potentially. They might start valuing it closer to higher growth peers. But failure to reignite billings, well, that risks the story devolving into just a margin support only thesis, especially amid accelerating sector consolidation.
Makes sense. Okay, time for our This Is Not Financial Advice segment,
Always fun.
where we kick around some outrageous but plausible trade ideas strictly for discussion and entertainment, maybe like we're pitching to an investment committee. And remember, everyone, this is absolutely not investment advice.
Please don't trade based on this.
Given Check Point's market reaction, that core divergence between solid fundamentals and guidance versus investor anxiety over growth, that's a classic setup, right?
It really is. Okay, here's one idea. It's sort of a show me trade. You could essentially bet that the stock might dip further or stay low in the short term, say, through Q3 results due to that continued market skepticism over billings and the growth story. Maybe use a near-term put spread on CHKP.
Betting on continued doubt.
Exactly.
Yeah.
But simultaneously, you could position yourself to profit if it rebounds significantly over the longer term, perhaps into 2026.
Yeah.
Layer in a long-dated call spread. Maybe.
Okay.
Positioning for a re-rating if Check Point actually delivers on its Veriti integration, the AI-driven innovation, and that promised billings acceleration from those catalysts we mentioned, the Infinity launch, federal awards, etc.
It's like saying, I doubt it now, but I believe in it later. Capitalizing on present doubt for future potential.
Precisely. A classic show-me situation.
Interesting. Or how about a relative value play?
Okay, like a pair trade.
Yeah, pair trade. Maybe going long, Checkpoint buying its shares, and at the same time, shorting a peer in the cybersecurity space. Maybe one that trades at a much higher revenue multiple, but potentially lacks Checkpoint's, margin resilience.
Betting on fundamentals winning out eventually.
Sort of. The thesis here is that in a consolidating market, maybe one that's slowing in certain segments, Checkpoint's deep profitability and cash generation provide a solid floor.
Hard to fall much further with that kind of cash flow.
Right. And any successful reignition of growth, even just incremental growth, could then close that valuation gap relative to peers. It could potentially outperform a higher growth but less profitable competitor.
So you're betting on the market eventually appreciating the margin fortress again, especially if the growth angst resolves even just a little bit.
Exactly. Betting stability might win out. Again, just ideas, not advice.
Definitely not advice. Okay, so to recap our deep dive, Checkpoint delivered solid top and bottom line beats and reaffirmed its full-year guidance.
Driven by strong appliance demand and those strategic investments in AI and SaaS.
Yet the market reacted sharply, very sharply, to a billings miss. This really highlights investor focus right now on growth acceleration and pipeline velocity, especially amidst broader sector consolidation in the industry.
The company is clearly navigating a complex shift towards an AI-orchestrated, cloud-delivered platform, and they have a clear roadmap of catalysts ahead.
They do.
So the crucial question for you, the learner, is what this quarter tells us about current market priorities in cybersecurity. Is it margin resilience or top-line acceleration that truly moves the needle for these valuations going forward? Something to think about.